Welcome everybody to the tax sections program on 1031 exchanges. I'm Michelle Weiss. I'm the chair of the tax section. But before we begin, we have a couple of housekeeping announcements. First of all, you'll receive your MCLE certificate shortly after the program. Your certificate will also be stored in BHBA Plus, our members only community. Of course, that's if you're a member. Please take a moment to complete the survey that is included with your certificate. Also letting you know that this program will be available in a couple of days in BHBA On Demand, BHBA's newest member benefit, presented by Lawyers Mutual Insurance Company. I also want to thank the real estate section for co-sponsoring our program today. And our tax section is sponsored by the firm of Hochman, Salkin, Tasha Perez, PC. They've been a staunch and consistent sponsor of the section, and we appreciate their sponsorship. The Hochman, Salkin, Perez, PC advantage is experience, an eye for innovation, and a genuine dedication to clients, their families, and their business. In addition to their national practice in civil tax and criminal tax controversies and related litigation in federal and state courts, the firm is also active and successful in handling non-tax matters such as business and estate planning for high net worth individuals and closely held businesses, together with white-collar defense and commercial disputes. And so welcome everybody to our program. I'm going to briefly introduce our speaker and then turn it over to him. Our speaker today is Lou Weller, who is an expert on all things 1031 exchanges. He's based in Sausalito and is the managing partner of Weller Partners LLP, a boutique law firm specializing in tax planning for real estate transactions. Lou formerly served as National Director of Real Estate Transaction Planning at Deloitte Tax and is recognized as one of the leading national authorities on tax planning for real estate transactions, particularly in using like-kind exchanges and other means of deferring gains on real estate sales. Lou is a frequent speaker at tax institutes and conferences and is the lead author of the treatise, Real Property Exchanges, 3rd edition, and has been widely published in the tax press, quoted on real estate tax subjects in national periodicals and newspapers, and serves on the editorial board of several national publications. He has leadership posts in the ABA tax section, the California State Bar tax section, and the taxation section of the Bar of San Francisco. He's a fellow of the American College of Tax Counsel and has been listed for more than 30 years in the best lawyers in America. He received his BA in political science from Yale and concurrent JD and master's in public policy degrees from UC Berkeley. And so it is my privilege to introduce to you Lou Weller. Heads up is Lou has asked if you have any questions about the program today, please put your questions in the Q&A and Lou will address the questions at the end of the program. I think Lou, you said you leave about 10 minutes at the end of the program to address participants' questions. Okay, all right, everybody. So thank you so much for joining us today, and Lou, take us away. And Lou, also, this would be the time if you want to screen share, is a good time to start screen sharing. If you're able to. Okay. Let me know if you need help.
There.
Okay. There you go. All right.
Okay. Well, thank you for having me, Michelle, and welcome everybody. The objective today is to take a moderate dive. I won't even say deep because we don't have time, into some issues that come up in probably the most common circumstance, at least that I face in practice, which is partnerships selling property and not wanting to stay together. And it's something that anybody who works in this area sees daily and comes up. And unfortunately, there are no clear answers, but I'll try to give you an overview of the lay of the land, both from a federal and particularly from a California perspective, and I'll explain what I mean there in a minute. So a couple of things, let's see here. Why? Oh, okay. You have to get used to me not being completely familiar with this particular technology. But anyway, I wanted to sort of level set the rules that are listed here. And excuse me, I've got COVID, so I'm going to drink a little bit to clear my throat as we go through. The rules, these 4 rules are applicable to all exchanges, but particularly to partnerships. First of all, there's the same taxpayer rule. The same taxpayer that disposes of relinquished property must acquire replacement property. and thereby complete their exchange. Both relinquished and replacement property have to be held for productive use in a trade or business, the well-known held for requirement of 1031A. Since 2018, only real property may be the subject of an exchange. Before 2018, you could exchange lots of kinds of personal property, but even before that, since 1984, partnership interests were not currency that could be traded in a like-kind exchange, regardless of the assets in a partnership to which they related. And we see quite often assertion of various judicial doctrines to try to take out of 1031 transactions which were structured to be in 1031 using substance over form and court holding, which is an income attribution doctrine, which I'll talk about in a little bit. And these particularly apply to transactions subject to the California Franchise Tax Board's jurisdiction, because, as we'll hear, we live in a state where 1031 transactions, particularly those done by partnerships, are under a microscope. And anybody in California needs to be aware of the very different regime that we have to deal with compared to much of the rest of the country. Okay, there are 4 fact patterns which you will see. The most common is when partners are selling a property, a partnership is selling a property, and people don't want to stay together. People want to either some sell, some trade, some do separate exchanges. There's a divorce going on, I call it, of one form or another. This, I think, it's fair to say, is the most common fact pattern and is the one we will focus on in this conversation. There are 3 others that I don't want to ignore, but we will not focus on. One is where the partnership itself does an exchange and then acquires either one or multiple properties, which it then distributes to its partners in liquidation after the exchange is completed. Another is where a partner wants to become part of a partnership using property that the partnership doesn't want, but contributes property to a partnership, which then sells and does a 1031 exchange with that property. One could call this transaction a Section 721/1031 transaction. Why? Because the contribution, step 1, is designed to be tax-free under Code Section 721, and the exchange by the partnership is designed to be tax-free under Section 1031. Probably a more common transaction is, in effect, gets the same place, but in a different way. And that's where the partner who's selling property completes their own 1031 exchange. And then later it acquires replacement property and then contributes it to a partnership with others. That's generically called, and you'll see this reference quite often, that's generically called a 1031/721 transaction. Why? Because the 1031 exchange by the partner precedes the 721 contribution of the property to the partnership. Those are transactions done all the time, but we're not going to focus on those. That's a topic for a different day. But it's something that I've had already today, 2 calls on that, how to do and how to structure transactions like that. Okay, so let's talk about just a basic fact paradigm. Try to keep it simple. Think about an LLC or any entity taxed as a partnership. Commonly, I'm sure everybody is used to using LLCs. We frequently see limited partnerships, particularly in Texas, where you get a better franchise tax result, and sometimes in California, where we sometimes get a better franchise tax result. But we're dealing with something taxed as a partnership, and the paradigm here is 3 equal parties are members of this entity, partners for tax purposes, and we've got a fairly simple asset structure. We have a value of 900, basis of 300, no debt. So we have quite a bit of what's called built-in gain, equal to the $600 difference between value and basis. And so people want to do a tax-deferred transaction, or some do, on the sale of this asset. Okay, so in the example, we're going to say one of the three wants to cash out, and two of the three want to stay together. Sorry, my computer clock is blocked, so I had to move a clock over so I don't run out of time. In the example, a couple of alternatives, obvious alternatives that make life relatively easy from a tax perspective. One, A and B just buy C out for the $300 that C's share of the property is equal to. A and B take over. It becomes the AB LLC. A and B have, if they spend an equal amount, now have gone to have 450 of basis. They've just spent 300, so they'll get a step up under section 754 of what they just paid. To the inside basis will step up through the 754 election by another 300 and by 150. The difference, the built-in gain that C recognizes on that sale, and A and B can go along and do an exchange, just no problem. Simple transaction, and the one that often is recommended to save hassle. Okay, or if LLC has got money, reserves, access to capital, other things, LLC can redeem C for the same $300, leaving A and B as owners, and proceed again with an exchange. In both cases, LLC will still need to buy $900 worth of property. You will not get to reduce the amount of exchange property LLC must buy for a fully deferred exchange by either of these techniques. Number three is one we don't normally recommend. It's the one people want to use. It's the most obvious one. LLC simply sells parcel X for $900, segregates $300 from what it sends to a qualified intermediary, sending $600 to the qualified intermediary, segregating $300 and gives it to C. What does that do? That creates $300 of boot, because the cash is not used to buy replacement property, it's boot. Problem. That $300 of boot is more than C's share of gain. C's share of gain, realized gain, is a third of 600, is 200. So you immediately see a problem that results from the special allocation approach to allocation of boot gain, is that it doesn't fit the economics of the deal. Most tax planners, and this applies across the country, do not believe that this special allocation satisfies substantiality under the 704B regs, because it doesn't follow the economics associated with the transaction. There is a group of people, not everybody, but some, who believe you can do what's called fill-up allocation and say, okay, on the sale of a $300 interest, C's share of that sale should have been $200 gain and $100 recovery of basis. So what if we simply allocate $200 of the gain to C, the right amount, and what happens? That leaves A and B quite unhappy, because they have to be allocated the other 100 and recognize gain when they didn't want to get any. People do believe that can work. And where you have small enough amounts of gain, some people are willing to try that. I do have to tell you that I was the lead 1031 partner at Deloitte for a number of years. And the National Tax Office would not allow Deloitte to sign tax returns doing even that, because they did not believe that even that kind of fill-up allocation satisfied substantial economic effect. So there are serious tax issues and consequences and risk associated with any attempt to simply give boot gain to a cash out member or partner and allocate that gain to that party. Not to mention the fact that the gain will attract section 1250 recapture. If there's any depreciation taken on the property that was sold, that will be recaptured when gain is recognized. It will all attach to the boot. So by allocating the gain entirely to C, if this property's basis of 300 had been reduced from, let's say, 600 by $300 of depreciation, then instead of that gain being taxed at 20% federal, it'd be taxed at 25% federal. And the C may not be happy with that. Now that can sometimes be negotiated. You can have makeup provisions, other kinds of arrangements that parties can enter into, but you can't forget the recapture aspects. It's not technically recapture when you're talking about Section 1250. It's a difference in tax rate, but it is a difference of 25%. So what do we do in light of inability to do one or two and not disinclination to do number three? We pursue a drop and swap transaction, which is the most common transaction I know of in 1031. So what is that? Drops and swaps involve conversion of interest in partnerships or membership interest in LLCs into direct interest in property through distribution of tenant common interests. And it's a simple thing. Most of you probably are familiar with this. LLC, instead of just taking money and giving it to C, gives C a 1/3 tenant common interest in parcel X, leaving itself as a 2/3 tenant common. Then at the closing, C sells the 1/3 interest C has received to buyer for $300. LLC sells the 2/3 it's retained for $600. And away we go. Because each side, if that transaction is respected, is a separate seller. Tenant in common is a separate seller from other tenants in common. And therefore, each side gets exactly what they wanted. And notice a couple of things. The benefit of this transaction is C's basis has grafted onto the TIC interest. So you get the right amount of gain treated as being recognized by C. The 300 they receive less 100 their 100 basis. And secondly, LLC's exchange has now been reduced from one in the prior slide that would have required $900 of replacement to one that only requires $600 of replacement, because that's what it's sold. So the drop and swap has a lot of advantages. Question is, will you respect it? Will not you? You will. Will the Franchise Tax Board or the Internal Revenue Service respect it? There is controversy about that. Code section 761A, probably not available. You can't elect tenancy and common treatment for most income producing real estate. At least the Internal Revenue Service doesn't believe you can. There are revenue rulings that say you can and you can't. 75-374 respected the TIC, that this is the TIC structure respected. 75-374 was a joint venture of two parties in an apartment project and respected the tenancy in common structure. RevPOC 2002-22 does not apply because on its face it says that it doesn't apply where interest in a tenancy in common have been received in distributions from a partnership. 2002-22 is a peculiar ruling. It's a procedure. It's not a safe harbor. It's a ruling guideline. You have to really go into its history and its rationale to understand that fundamentally 2002-22 doesn't have a lot to do with drop and swap transactions. I can go into the detail. I was involved in creating it. I was involved in the tenancy in common industry when it was created. A former Deloitte partner of mine was the lead treasury attorney, a tax attorney who worked on the project, and I had long discussions with her about some aspects of it. And she conceded that it was the rules of 2002-22 are quite conservative. The terms that you have to have in a tenancy in common to get a ruling under it are very, very far to the conservative side of a spectrum of what's a legitimate tenancy in common. So you have to understand all that before you blindly apply 2002-22 as a litmus test. And frankly, the taxing authorities know that. They've acknowledged it. One thing you do need to be careful of, though, is any tenancy in common, you at least pay homage to the fundamental characteristics of what distinguishes a tenancy in common from a partnership. And that is, partners don't have a right of partition, tenants in common do. Partners sometimes have major restrictions or prohibitions even on transfers. Tenants in common can't. There's four things that the Revenue Procedure 2022 identifies as sort of fundamental to tenancy in common interests. One is the right to decide whether to sell. Another is the right to decide whether to put a lien, that is, mortgage your property. Another is the right to decide who will be managing your property. Another is the right to decide whether to lease it. We generally require unanimous consent for those things because most people agree they are fundamental characteristics that distinguish tenancies in common from partnerships. But there's a whole raft of other things that one can look at to make a decision. The best advice is observe formalities if you're creating a tenancy in common arrangement of what real tenants in common would do. They'd let the tenants and lenders of the property know that they were tenants in common owners, not partner owners. You'd have a deed that transferred title. You'd have separate participation in purchase and sale documentation. And if you don't do that, then you might find yourself in the position that a guy I knew, whose name is Del Chase, found himself in. You might see that I've sort of been in this game a very long time, and it's a very small little world. So we all know each other. Del Chase was a real estate developer in the Bay Area, San Francisco Bay Area, sold a large apartment project, decided he wanted to do his own exchange. So he deeded some property to himself. Partnership sold. He treated everybody else as selling and tried to do his own exchange. The commissioner said, no, you didn't do this right. You didn't tell anybody. You didn't have any right under the partnership agreement to do what you did. We're just going to ignore it. And that was the tax court's conclusion. So the Chase case is an example of what not to do when you're doing these kind of structures. One thing you should try to do is do it sooner rather than later. It's common to do these transactions immediately prior to the closing of the sale. Can you do it concurrent with the closing of the sale? Can you do it before you sign the purchase and sale agreement? That's the best thing to do. To be honest, the California Franchise Tax Board, and I'll get into their position in a second, concedes that if you do a conversion, a legitimate conversion to a tenancy in common structure, before you market a property, they will respect that. You've got to walk the walk and talk the talk, but they will respect it. What they will do, however, and this is the important thing, they will take the position that if the partnership or LLC has signed a sale agreement, and maybe even if it's signed a letter of intent that on its face says it's not a sale agreement, but implies, according to the FTB, a duty of good faith and fair dealing to negotiate a sale agreement, they'll say it's too late. You're already committed to sell at the partnership level, and it's too late to drop an interest out to an individual partner. We will treat that as being a nullity, and we'll look at the transaction as being a bad exchange because the partnership sold and it didn't complete the exchange. So the key litmus test in California is, are you under agreement to sell? That's when we start doing different things as far as planning, which I'll describe in a second. What if the buyer doesn't consent? Well, that's generally not a problem. You want to get buyer consent to exchanging. And if you are thinking about doing any of these transactions, you are well advised to put in what I'll call a robust exchange cooperation clause. There's a body of law led by the case called Cumberland Public Service Corporation, which is the antithesis of court holding. And in that case, court holding was a US Supreme Court case, which held that a corporation had agreed to sell property, and it was too late after that agreement was entered into, even though it was an oral agreement, for the corporation to dissolve and liquidate and distribute its property out under former Section 333, Code Section 333, which allowed corporations to do tax-free distributions. Well, some people 5 years after this Supreme Court case came out decided, well, what if we agree that the sellers are going to be the shareholder? It was still corporate context. But we agree that the shareholders are going to be the sellers, even if the corporation owns the property at the time an agreement is entered into. And that's the way we'll document it. And the commissioner challenged that by saying, you still signed the contract when the corporation owned the property, it's too late. And the Supreme Court said, no, the parties showed who they wanted to be the seller. And we will not attribute the corporation as a seller when the parties in the contract said they were going to be the sellers, which invites you to think about drafting robust exchange cooperation clauses, which give owners of a entity, a partnership in this case, the right to convert to co-tenancies and the obligation of the buyer to respect that and recognize the co-tenants as substitute buyers. We do that all the time. And it's highly recommended if there's any chance at all, if you're working on a partnership that's going to be a seller, that it might want to do a transaction like this, a divorce transaction, to signal that in the documents. That's a big problem, because debt normally provides that you can't transfer the property without the lender's consent. Well, a deed out of a tenant in common interest is a transfer of the property. And if you don't get lender consent, you're violating your loan covenants. It's done all the time. People do this every day and take the chance that the lender is going to get paid off. The time this is a real problem, again, this is another topic for an hour discussion, but the time it's a real problem is if the buyer is going to assume the debt. I just had a very, very large, over $500 million transaction where it was like, we were doing drop and swap transactions, but the lender was going to stay in place. So we had to get lender consent to get assumptions of the loan by the interim tenants in common, who could then transfer to the buyer. Cost a lot of money, took a lot of time, but the scale of the transaction was worth it, and we got it done. But that's a problem that it was a CMBS loan. You all know, I'm sure, what that means, but we got it done. Okay. Final issue, people raise it all the time, is okay, if you do one of these transactions and C gets a tenancy in common interest and doesn't hold it for very long and then transfers it, how do they satisfy the 1031 test? Well, I don't mind going on record saying they do. The law is clear. I wish people would stop raising the held for test in this context. Magnuson, Bolker, Mason, Maloney all say that there is no minimum holding period required when somebody gets an interest in property in a tax-free non-recognition transaction and then does an exchange. The law is completely clear about that. These old 1970s rulings no longer are treated as governing this set of transactions. They don't really apply anyway. But by the way, both the Internal Revenue Service and the Franchise Tax Board have announced they are not going to be asserting the held for test in drop and swap transactions. So please tell any accountant that raises this, is usually the CPAs, to go read the law, because they're inventing a problem which doesn't exist. So the problems do exist, though, especially in California, where you've got transaction that is structured after the PSA. So what's the solution? It is called the partnership division. This is a transaction we do all the time primarily in California, but sometimes in other states. Why? Because the California Franchise Tax Board, in its wisdom, has decided that you can do a drop and swap transaction as long as you do it as a partnership division. And it can be done after the contract to sell the property has been entered into by the LLC. What is a partnership division? It's a creature of the code. It's a creature of Section 708. And what it says is, when you split mother amoeba, I use the term amoeba when I describe this to people, when you split mother amoeba up into baby amoebas, as long as the baby amoebas satisfy a particular requirement, then they are treated as continuations of mother amoeba. And that's the core rationale why FTB believes that this is okay. And partly it's attributable to corporate law. There's private letter rulings that say you can do corporate reorganizations before, midstream, or after an exchange. As long as 368's continuity and other continuity rules apply, that's okay. The same exchange, the same taxpayer rule isn't prejudice. So the FTB has decided, okay, even though we don't have the same law in subchapter K, if you do something that parallels a reorg, we'll let you do that transaction. So you'll see the example. Before the sale, maybe even during the exchange, but I'm not going to get into that now. I'm not a complete believer that you can do it after the sale occurs, but everybody who looks at it tries to do it before the sale. You split Mother Amoeba old LLC into two, and you transfer a percentage of the property to a new co, and the new co has very, very specific requirements to be regarded as a continuation. And what is this? What is the requirement? A, it's got to be a partnership. NewCo can't be a corporation, can't be an individual. Got to be a partnership for tax purposes. And B, its partners have to have had more than 50% of the interest in OldCo. That's what this diagram, but they do not, and the key is they don't have to have the interest in the same percentages that they had in OldCo. So that's what this diagram is illustrating. Notice we went from A, B, C, who each had 33%, to a transaction where A and B now have 49% of the original, and C has dropped to 2. And C has 98% of NewCo, and A and B have 1. This example actually goes even further than you have to. And why do I say that? Technically, C would not have to remain a member of original for NewCo to be a continuation. You don't look at whether the original partners still have interest in the old partnership. You look to see whether do the partners of that remain at the end of the day of original, did they have more than 50% of original? Well, yes, A and B had 66%. Now they either have 98 or 100. Now look at NewCo. Do the partners of NewCo comprise parties who had more than 50% of OldCo? Well, they do, because we have all the partners of OldCo as partners of NewCo. Therefore, the partners of NewCo had 100% of OldCo, even though their interests are radically different. That's the technology that we use in division transactions, and one where, at least over the last couple of years, the Franchise Tax Board of California has consistently changed partnership divisions transactions, drop and swap transactions structured in this way that have been done using this format. Okay, the key is that NewCo is a continuation. They do not assert court holding. That's the key. They say, okay, as long as NewCo is a continuation, it can step in the shoes of OldCo with respect to obligation to sell. We don't have an assignment of income to somebody else because NewCo is a continuation. That's key. I've already talked to you about the held for test. Again, it's a red herring. It's not been raised in any of the FTB audits. I've had FTB audits where it's been raised in other contexts, where they're now withdrawing assertion of the held for test issue in these situations. But so now these parties are going to do one of two things. Either original is going to come. We know original wants to do an exchange. We don't necessarily know that C wants to do an exchange. So if original does its exchange, what of the 3 property 200% rule tests apply to it? My view is these are separate taxpayers. There is no authority, but I think it's fair to say that one could pretty comfortably conclude that original has 3 properties it can identify. New LLC has 3 properties it can identify if it wants to do an exchange. The 200% test will operate, pro rata. Original will have to use 200% of the value it got in the division. New LLC will have to use 200% of the value it got in the division. if it's doing the exchange, to apply to the ID rules under 1031A3. But the point of this is to give you all the guideline to what is current practice in California. Actually, one of the leading exponents and most advanced practitioners of this, and I think I'm going to use his name not in vain, but in admiration, Skip Kessler, who practices in Beverly Hills, is a well-known expert in this area, one of the leaders in the development of this approach. And I commend Skip for all the work he's done in developing this. I don't know if he's on the, Skip, if you're listening, nice to talk to you. If not, you deserve to be known for your work in the area. Okay. What if for some reason you can't do this? Yeah, let's talk about a couple other options. Okay. Sometimes it might be too late. What happens if you've already sold the relinquished property and people want to do separate things, or for some reason you weren't able to get it unwound? You couldn't do a division because there was a lender who was absolutely not going to let you do it, or you had a buyer who wouldn't let you do it, or something like that. One thing people have tried to use over time is a tracking methodology. This is akin, if you will, to a mixing bowl, in that multiple properties are acquired by LLC, which remains owned by A, B, and C, but they're designed, and the allocation methodology is designed to basically track properties to specific partners. This example is a simple one. The hypothetical is you buy two properties, one for partner C, one for partners A and B. The parcel C, which is allocable to C, is allocated 95%. The P&L on it is allocated 95% to C, 5% to A and B. And likewise, you buy another parcel that is shared by A and B, they get 95% of that parcel's activity, and C gets 5. Those of you who've done mixing bowl transactions know this is the core issue, is how far can you go in allocating profit and loss from individual assets that are supposed to go really to a subgroup of people to that subgroup. You talk to people around the country, you'll get different opinions. I'm pretty comfortable with 5, as are many. Some people are not. Some people feel like you have to have 10%. I think most people agree. It depends on the scale. The bigger the numbers, probably the lower the percentage needs to be, because the number is still a giant number. Can you take it down further? Can you take it down to 99.1? That, in this case, 99% of parcel C to C and 1% to A and B. The issue is, have you had a constructive distribution of property where you're allocating virtually all the benefit and burden of the property to less than all the partners? And there's some law on that. It's unclear. Depends on intent, depends on the property. I can tell you that the kind of rationale people use is somewhere around the 5% is what people land as being somewhat comfortable. Everybody's comfortable at 10 that I'm aware of, and not everybody's comfortable at 1. And you got to sort of pick your poison. Okay. Question: what happens in a case like this where you've done this and you've let C go out and try to find parcel C, and guess what? C doesn't do it. Well, unfortunately, then you're back to the soup pot, because that's going to create boot. It's going to presumably create $300 of boot, not $200, even though C's gain is $200, because $300 of cash was not used, and it's an exchange by LLC, so that's going to be taxable in full. And then you're going to be back to the issue of, can you specially allocate all that gain to C? Well, probably not. Can you allocate 200 of it to C and 100 of it, forcing B and C to get 100? And what happens in the future? Can you exit? You presumably will redeem C out now for cash. Can you redeem C out in the future? Let's say you didn't fail, you did what you planned, but A and B don't want C as a partner forever. It's cumbersome. How soon can C be pulled out of this deal? That's another question. Normally, my view is, personally, you got to let the dust settle. You got to wait a couple of years at least. Some people want to do it sooner. My view is, you all know the sort of mantra of tax planning in this area. File 2 years of tax returns before you make changes. That applies here as in other areas. And all I can do is say it's a debate that's a legitimate debate that regional minds can differ on. Ooh, wrong way. PINs. Some of you may have heard about PINs. PINs are partnership installment notes. PINs are used where you have one partner who wants cash. It does not work and not intended to work where C wants to do their own exchange. But if C wants cash, the PINs structure is designed for that. Why? Because it's designed to take $300 of cash that will be paid by the buyer, let the qualified intermediary keep it, and have the qualified intermediary issue a $300 note to LLC at the closing of the relinquished property sale, which note has some interesting terms. The note will normally have the bulk of its principal, let's just say $280 for a $300 note, or $270, 90%, payable in a couple of weeks after the closing, with the balance payable at the beginning of the next year. Why? That's how you get installment treatment. You have to have a payment and an installment due in the year following the sale. So a payment must be due in the following year. The entire payment could be due in the following year. If you're closing in November or December, you may want to, but at least some of the payments got to be due. Issues under the distribution. If you track the 731 is an issue, you have to deal with that. But by and large, a distribution of a note, the law is clear, where no gain has been recognized, transfers that gain out to the distributee in a non-recognition distribution. The whole point of PINs is to allocate the gain inherent in the note out to C. And what will happen when C takes the note, C's $100 outside basis will graft onto the note. So in C's hands, you'll get the right numbers. C will have a $300 note with a $100 basis. When the $300 is paid, C will get the right amount of gain. Technically, there's no question that that's how the system works. Problem, if there's been depreciation on the property, again, as I said earlier, with the special allocation of boot gain, the gain inherent in the note will attract all the depreciation recapture, the higher tax rate depreciation recapture, or actual 1245 recapture, if that applies. So if there is those kinds of things, you have to deal with the fact that C ends up paying a higher tax rate potentially. How soon to wait before distributing the note? Well, you distribute it right away. You distribute it before any payment is due. That's how you get the entire payments over to C. Debt is an issue. These transactions work best when there's no debt on the relinquished property. So as in the example, the reason is that that note does not carry with it any of the debt. So if parcel X is highly leveraged, LLC and A and B will have to replace all the debt in their exchange, not just the 2/3 that they would have been allocated if you'd done a drop and swap. So the transaction works less and less well the higher the leverage on a property is, because then all the remaining people have to replace all the debt. Security for the note, you can't use cash. You can't secure it with cash from the sale. What's typically done is it's either unsecured on the theory that the credit of the qualified intermediary is good enough for people to satisfy, to be comfortable. Or if you want, you can use a standby letter of credit under the 453 regs, which say that a standby letter of credit is valid security for an installment note and does not create constructive receipt of proceeds. So that's the solution. How to address it? You've got to build this into the exchange agreement. If you're going to do PINs transactions and you're going to use the qualified intermediary to make the note, it's got to be carefully laid out in the exchange agreement at the beginning. But that shouldn't be a problem because it doesn't actually get implemented until the closing. So you have time to amend the agreement to incorporate it up to the point of a closing, if that's what you want. And finally, I'm going to throw something at you that many of you may not have ever heard of. We call it a synthetic drop and swap. And it's a very sophisticated transaction, but has been used, and it actually works quite nicely in the right circumstance. It takes advantage of the fact that a Delaware statutory trust, many of you have encountered DSTs, I expect, if you practice in the 1031 area, because they're so commonly looked at as replacement property. But the use of one here is basically to convert a partnership into a tenancy in common, or constructively a tenancy in common, by converting the partnership, here the LLC, to a Delaware statutory trust. What happens? If you do it right, the conversion to the Delaware statutory trust means that the legal entity, the former partnership, dissolves. It is deemed to distribute its asset, parcel X, to the beneficial interest holders of the DST in proportion to their beneficial interest ownership, in this case, a third, a third, a third, and they have become, as a matter of law, 1/3 owners of the property. It's a beautiful technique. A little bit of hair on it. One, will a lender agree? There's no lender here, so we don't have that issue. Two, what kind of property are we dealing with? That's the real main issue. Because those of you who are familiar with DSTs know that the DST must be completely passive with respect to its property. And therefore, anything where there's active management needs to use a master lease, which has got to be put on top of the DST. This works best, and it's been used probably more often than any other context, where you're dealing with raw land. They love it in Texas, where they're selling ranch land, or even here, because if you've got low maintenance, low management raw land, you don't have any issue of a partnership being created by activities of the owners. The nature of the property is such that a DST can clearly own it, and you have managed to convert the partnership into co-ownership simply by filing what's called an interspecies transfer documentation in Delaware that converts the LLC to a DST. It's a statutory legal process, does not require a deed, does not require anything other than filing some papers, and lets A, B, and C each dispose of their interests in the properly formed and managed DST in separate 1031s. This one would allow A, B, and C to each entirely separate. Therefore, if A and B want to stay together in the future, you could do one of two things. You could give A and B a joint interest in the beneficial interest by letting them have a partnership, or let them buy replacement property as tenants in common. But you would need to think about, if A and B want to stay together and collectively buy something in their trade, as we had a paradigm before that, how to structure that best. But there are some options that are easily obtainable. So with that, I think my clock says that I'm at 1:20. So I'm going to invite our moderator to open up question lines because I can't see any of them, and tell me if there are any questions.
Yeah, hi. Okay, so we're back. We have a couple questions. Okay, I don't know if you would know the answer to this, but Robert Briskin asks, can you share with us any 1031 partnership cases currently in the process of being decided by the California OTA? Would you know about that? Any pending litigation on these cases?
I know there are a couple of cases. I'm not aware of what's pending at OTA on the partnership area. I'm aware of active audits and protests. So there's things that will go to OTA. I've got one if we don't succeed, but it's not at OTA yet. There is one at OTA. I'm aware of it. That's a very unusual one that has to do with whether or not a party who messed up in exiting a partnership at the part of a sale did it properly and could do the transaction they did, but it's very, very unique. And so I don't think it has much, it's not going to be of any real use to anybody. But aside from that, no, I'm not tracking what's going on at OTA. I can tell you there's going to be a new OTA judge. I just found this out that associate at a law firm that I do a lot of work with got an offer to join OTA and accepted it. So starting next month, we'll have a new OTA judge who used to be an FTB attorney. So she's not new to the system, but we'll see her. I'm not going to give you her name, but it starts with a V. So if you see a new OTA judge whose name starts with V, you heard it from me first.
Okay. All right. Thanks for that. All right. And Terry Maggedy asks the following question. Are there any opportunities for selling real estate held individually out of the USA, in this particular case, Israel, and doing an exchange for purchase of real property in the USA, Israel, or perhaps other countries outside the USA? I understand, and then he goes on to say, understand the answer may apply to US or California tax and not necessarily tax in Israel. So I guess it has to do with the property.
Yeah, I mean, the rules are clear. You can't trade from Israel to the US. There's a water's edge rule under 1031. Foreign property is eligible for 1031, but only if you acquire foreign property. Foreign property cannot be exchanged for US property, nor can US property be exchanged for foreign property. But a US taxpayer or anybody subject, it would only be a taxpayer subject to US tax law. Why would a foreign taxpayer not subject to US tax law care about 1031? So it only is a US taxpayer. But yes, a US taxpayer can trade Israeli property for property really anywhere in the world, not just Israel. There's no situs requirement for foreign property. It just has to be non-US.
Okay. So you can do foreign with foreign or domestic with domestic, but you can't mix them.
That is correct.
Okay. All right. Thank you. And Robert Conrad gives the following scenario. Party A exchanges his 100% interest in property 1 for an undivided 70% interest in property 2. There is no boot. Party B buys the other 30% in her name. Parties A and B own property 2 as tenants in common. Party A transfers his 70% interest to a wholly owned LLC. Any tax issue with B contributing her 30% interest to the LLC and receiving a 30% interest in that LLC.
There was no tax issue until the very last sentence. What was the last thing you said? The last.
So now party B wants to contribute her 30% interest to the LLC and receive a 30% interest in that LLC.
Yeah, I would not do that. I mean, that's in effect what I call a 1031-721. The reason is that the tax result of that transaction at the very end is the formation of a partnership between A and B. When B contributes her tenancy in common interest in the property to the LLC that party A formed, they are each treated as contributing property to a newly formed partnership. And party A is treated as contributing his 70%, and party B is contributing her 30%, but they're both regarded as contributing interest in property to a partnership, which may or may not be okay. If it's done immediately after the exchange, you'd have to be comfortable that a exchange followed by a contribution, that 1031-721 transaction I described earlier, can be done immediately. Some people are comfortable, some people are not. The Magnuson case had involved that fact pattern, but the Magnuson case involved a general partnership, not an LLC, and many people don't believe it applies. So I would wait. The normal advice on all 1031-721 transactions is wait at least over 1 tax year and hopefully over 2. I would not do the transaction that was described in a sequence of steps immediately. But that's the tax analysis is, does the formation of the partnership on B's contribution into this LLC poison A's original exchange?
Okay, all right. And Daniel Schwartz asks this question. You mentioned that you would tell us the FTB's current position on drop and swaps. Did you go over that? What is the current status of the old advice to wait 2 tax periods after the drop before swapping?
Okay, well, I tried to tell you the position is that it's too late to do a drop and swap if you do it after the contract of sale has been in, agreement of sale has been entered into, and they start worrying or asserting that there's an agreement when you have a letter of intent. So the current position is you can do a drop and swap if you do it before any sale activity occurs, and put people into tenancy in common. After sale activity occurs, you're best off using the division structure to accomplish drops and swaps. The FTB has abandoned asserting a qualified use requirement applies. So that over 1 year, over 2 years is irrelevant, frankly. And that's because people use those periods as ways to season qualified use. Well, if qualified use doesn't matter because they accept qualified use being applied, then that's the outcome. These are very subtle things, and there's no guarantee they'll stay in place. This is the current position, but whether they'll keep to it, we'll wait and see. That is my understanding, and others of the current position of FTB.
Okay, thank you. And Howard Crom has the following question. There was an 11th hour California drop and swap case decided for the taxpayer about 2 years based purely on the intention of the taxpayer, former partner, to do an exchange rather than a sale. The case indicated that intention was enough to prevail over the FTB. Do you have a comment on that?
Yeah, the Mitchell case, that's called the Sharon Mitchell case. The Mitchell case is a historical anomaly. You can't rely on it. The OTA has rejected it in 2 subsequent cases. The Franchise Tax Board completely doesn't follow it. And so it's a nice case, nice to have it. And I feel good about it because I helped win it. I worked on the briefs, but it's not going to get you anywhere. So I read it and don't rely on it.
Okay. All right. Thank you, Lou. So it looks like that wraps up all of our questions. I want to thank you so much. This was really informative and really appreciate being able to have this program for someone who's such an authority in the field. So thank you so very much.
My pleasure.
I want to thank everybody for attending today. You will get your CLE certificates shortly. If you're interested in becoming more involved in the tax section, we have our meeting on the 3rd Thursday of every month at 8:30 in the morning. And this month, it will be on October 20th. It will actually be our first in-person meeting since March of 2020. And it will be actually in my office at 315 South Beverly Drive, Suite 515. We have plenty of parking. We hope to see you there. You will be treated to a bagel breakfast and coffee. So hope to see you there. And our next program will be on November 1st. And I will be giving that program together with my colleague, Gary Slavitt, on employment tax, civil and criminal, employment, civil and criminal tax matters. So thanks everybody for attending and have a wonderful rest of your day. And for those of you who observe it, wishing you a happy and easy Yom Kippur and a happy and healthy New Year and happy and healthy year for everybody, whether or not you celebrate the holiday. Take care, everybody. Bye-bye.